7 to 1. That is the number, 7 paper ounces of silver for every single real, deliverable ounce sitting in a COMEX vault right now. Not a theory, not a projection. That is the official CME Group warehouse report as of March 5, 2026, and the registered silver backing that paper stack has collapsed 21.9% in 30 days. That drain is not slowing down, it is accelerating, and one specific contract month is sitting on top of a pile of paper that the math says cannot be honored. I am going to show you exactly what the 7 to 1 ratio means in mechanical terms, why the May 2026 contract is the specific flashpoint, what the documented history of institutional manipulation in this market tells you about how we got here, and what the 3 most likely outcomes look like from this position. This channel exists to cover the gap between what the financial press tells you about silver and what the CME data actually shows. Bloomberg will tell you silver futures are functioning normally. Fine, let them. What the registered vault data shows is a coverage ratio of 14.3% with a depletion track running out. In approximately 75 trading days, that gap between the headline and the data is exactly why this channel exists. There is one piece of data inside the institutional positioning picture that most people skip entirely. I am going to come back to it after I walk you through the delivery mechanics, because without that context it looks like routine market activity. It is not routine. If you are here because you want to understand what the numbers actually say before the crowd figures it out, tell me something in the comments. Do you hold physical silver or not? That is the only question. I want to know who is actually paying attention to this data and who is still sitting on the sideline watching it happen. And if this is the kind of analysis you cannot get anywhere else, hit subscribe and drop a like on this video, not for the algorithm. Because when the next warehouse report drops and the registered number moves another 5%, you want to be the first person in the room who sees it. The 7 to 1 ratio is not the ceiling. It is the current floor. Now let me show you the institutional actor at the center of this story. That actor is J.P. Morgan Chase. Here is what is documented in official proceedings. On September 29, 2020, the CFTC issued an order against J.P. Morgan Chase and its subsidiaries requiring payment of $920.2 million, the largest monetary relief amount ever imposed by the CFTC. The DOJ entered a deferred prosecution agreement the same day. The finding, from at least 2008 through 2016, J.P. Morgan traders placed hundreds of thousands of orders in precious metals futures contracts, including silver, with the intent to cancel them before execution. That is the documented, officially admitted playbook. Place fake supply, push price where you want it, cancel the order, profit on derivatives. 2 of those traders were convicted and sentenced to federal prison in August 2023. The playbook works like this: accumulate a position, generate artificial supply on the paper side to suppress price, buy back cheaper, profit. The CFTC chairman said it plainly in the official release. Spoofing is illegal, pure and simple. I am not making an allegation. I am reading from a court document. What the January 2026 delivery record actually broke inside the vault is something I am going to show you in detail in the next block. Hold that number, because what happened in January changed the structural setup for every delivery month that follows, and that covers the documented history. The current setup is a different conversation. Here is the raw data, pulled from CME Group warehouse reports as of March 5, 2026. Registered silver, the metal that can actually be delivered against futures contracts, 81.2 million ounces, down 21.9% over 30 days. That is 22.8 million ounces pulled from the deliverable pool in a single month. Eligible silver, metal sitting in COMEX vaults but privately owned and not available for delivery without conversion. 270.1 million ounces, also falling, down 10.5% over the same 30 days. Total open interest, the paper claims outstanding against that registered pool, 569.5 million ounces. Paper to physical ratio, 7 to 1. 7 paper promises for every ounce you can actually touch. Delivery coverage ratio, 14.3%. Below 15% is the official stress threshold. The COMEX stress index sits at 82 out of 100. The all-time high is 88. At the current withdrawal pace, registered silver runs out in approximately 75 trading days. That lands around mid-June 2026. And that number underneath the registered figure is the one that should concern you. Total vault net outflows, registered plus eligible combined, over 30 days, negative 54.5 million ounces. The eligible buffer is draining alongside the registered pool, not replenishing it. Most people who see a 7-to-1 paper ratio think, okay, but futures always exceed physical. That is true in stable conditions. The question is whether the trend is stable or in freefall while deliveries accelerate in the opposite direction. January 2026, 64.7 million ounces delivered, a record. February, 25.2 million ounces. March partway through, 32.3 million ounces. 3 months, 122 million ounces of real metal delivered, against a registered vault standing at 81.2 million ounces today. That is the number I told you to hold. January alone wiped 26% of registered stocks in a single delivery period. The vault never recovered. Now here is what the May 2026 contract looks like specifically. May 2026 carries 77,302 contracts of open interest. Each contract is 5,000 ounces. That is 386.5 million ounces in paper claims against a registered vault of 81.2 million ounces. May open interest alone is 476% of total registered silver. The math to break the vault: 16,240 contracts standing for delivery. That is 21% of current May open interest. 1 in 5. If 1 in 5 May contract holders demands physical metal instead of rolling or cashing out, the registered vault cannot fulfill the demand. The July 2026 contract is already showing 98.4 million ounces in open interest and posted the largest single-day open interest increase of any month. On March 5, 2026, the squeeze pressure is rolling forward, not resolving. Now let me give you the honest counter-argument because it deserves to be stated plainly. The case against the squeeze narrative is this: open interest is not delivery demand. Most futures participants never intend to take physical delivery. They roll the contract or cash settle. The COMEX system runs on warrant transfers, not metal movement. The same bar can satisfy multiple delivery obligations by changing paper ownership, without leaving the vault, and the exchange has emergency authority to modify settlement terms during stress periods. That is the Steelman. It is a real argument. It is not wrong in principle. Here is where it breaks down against the current data. The 3-month delivery run is not theoretical. 122 million ounces of verified CME Group delivery notices have been issued since January. That is not open interest. That is settled contracts physically. The eligible to registered conversion buffer is supposed to act as the relief valve in stress conditions. That buffer is also draining, down 31.6 million ounces in 30 days, not replenishing. The emergency rule change option exists. It has been used before, but using it is not a neutral event. It is a price discovery admission that the paper system could not honor its obligations through normal mechanics. The algos can manufacture chop in the paper price. They cannot manufacture silver supply. That gap is structural, not cyclical. Here is what to watch from this position. The single most important number 2 track between now and May 1st notice day is the registered silver figure in the daily CME warehouse report. Specifically, watch whether eligible to registered conversions accelerate. If large eligible holders begin warranting their metal into the registered pool, it signals they believe delivery. Demand is real and they want to capture the premium. If the registered figure keeps falling while eligible also falls, the relief valve argument collapses. Watch the July open interest trend. A second major contract month stacking above the registered vault level while May is still draining means the pressure is not being resolved, it is being deferred. Verify the data yourself. Pull the CME Group Daily Warehouse Stocks report directly from the CME website. Cross-reference with CFTC Bank participation reports for institutional positioning. The Gold-Silver Data iDataTrack dashboard aggregates the official CME data in real time if you want a single consolidated view. Check the CFTC enforcement record on JP Morgan directly at cftc.gov, press release number 8260 from September 2020. Now let me speak to each group watching this specifically. If you hold physical silver, the structural data has not changed in your favor, it has tightened further. Coverage ratio at 14.3% with 3 record delivery months and a drain running 2-0 in 75 days is the environment your position was built for. Hold position. The fundamentals have not deteriorated. They have accelerated. If you are trading futures, the May contract is where the mechanical stress is concentrated. Watch first notice day positioning in the final 2 weeks. Roll or close decisions made by large commercial longs in that window will telegraph whether the delivery pressure materializes or dissipates. This is not a signal. This is educational. Context for your own analysis. If you are in silver ETFs, understand that your exposure is to paper price discovery in a system where the delivery coverage ratio is at stress levels. That is not a reason to panic. It is a reason to understand what your instrument actually tracks and what it does not. Do your own homework on custodial arrangements. If you are watching from the sidelines and this is your first time seeing this data, the one number to remember is 14.3%. That is how much of the paper silver market has real metal behind it right now. Officially, per CME Group's own reports, decide what you do with that information using your own brain. Scenario 1. Bullish. The registered drain continues. Eligible to registered conversions do not keep pace. May 2026 sees elevated delivery demand, and price discovery begins repricing physical scarcity ahead of the June depletion timeline. Analysts including Goldman Sachs and Citi have projected silver in the $85 to $110 per ounce range for 2026 under physical scarcity conditions. Probability, 40%. Scenario 2. Neutral. Large longs roll May positions into July and beyond. Eligible holders begin warranting metal to stabilize registered stocks. The 7-to-1 ratio persists but does not immediately force a delivery crisis. Price trades sideways to modestly higher as the structural imbalance remains unresolved. Probability, 40%. Scenario 3. Bearish. Institutional actors coordinate a paper price suppression event ahead of May 1st notice day, triggering retail stop losses and reducing the number of longs standing for delivery. Registered silver receives a large eligible conversion deposit from a single commercial holder, and the coverage ratio temporarily recovers. The squeeze is deferred to a later contract cycle. Probability, 20%. Everything covered here is for educational purposes only. This is not financial advice. Use your own brain. Do your own research, always. Physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly.